long the OC 145 call. We're short the September 145 call. Okay, and that's 275. Now what I want to do is let's look at the put time spread. So the put time spread, as we can see, the OC is 365, 375. All right, and the September 45 spread is 93.97. So 95 we'll use in 370. So 95 cents and 370. So we're going to use for our prices on that 275. Okay. So we're going to use 275 as well as the put time spread of the SEP OC. So what I want to get to and show, okay, let me get over here with our little marker. Is the call. All right, what we did there is we paid 275. All right, and the put, what we did was we got 275. So we bought the call spread, we sold the put spread for 0. Okay, so what do we have on? Well, we're long right here the OC 45 call, right? We're short the SEP 45 call. Just want to mark these up so we got it. Okay, we're short this put and we're long this put. Okay, so now we're saying we're looking at this position, and what do we have on? Well, if we're short the OC 45 put and long the OC 45 call in October, we're sitting on, if you remember our qualities, long stock. If you look at our September position, we're long the put and short the call. So our September, we're short stock. So when you look at it, the jelly roll, what you've just accomplished is with two time spreads, using the same months in each of the spreads, using the same strikes, we've bought the call spread, we sold the put spread, we did it for even, is our price that we did all 4 legs. We bought one, we paid 275 for this one, which is the minus. We collected 275 for that one, and that was a net of 0. We're equal. We have a position on its short stock versus long stock, so it's dead flat. And the reason why I'll explain that to you is that at expiration, regardless of where Goldman Sachs closes, the call is either going to be in the money to make a short stock, or the put's going to be in the money to make a short stock, because we're short the call and long the put. So either way, we are going to be short stock. And our position out here in the October is short the put and long the call, which is synthetic long stock. So at expiration, we're going to end up with short stock against short put, long call, which through the jelly roll has put us into a reversal. Now, when I was doing the math for you earlier, I showed you that the short stock interest, because we're saying there's no dividend, the short stock interest was basically going to be, okay, I think we talked about what it is, okay. The short stock interest is the strike, which is in this case is the 145. Let me see. Well, let me see if I can get this fit this in here for you. Okay, so we got 145 okay, times our interest, which in this case we're going to use 0.0025, which is 1/4%, okay, divided by the days in the year, which is the 365, and then we're going to multiply that times our days to expiry, which is basically, in this particular case, is the difference between the two, which is the 36 and the 28. So we got 28 days. And we said that was equal to, let's do the math real quick. .0278. So we're going to say roughly, come over here, little guy. So basically plus 3 cents. So what we've done by buying the one call spread and selling the put spread in each of the time spread is a jelly roll, which converts into a reversal, which basically is something that we did for even with the prices that we used, and we're making 3 cents for every contract that we traded that. So 3 cents, you know, let's say we did it to 10 times. We get 10 times minus the 03 times 100. So in this particular case, a one lot, we're locking up $30 minus some of our expenses. So here's a spread that we laid into one side, and if the other side becomes available, we could put on the other side of the spread. It's a dead neutral trade. It turns into a perfect position for a reversal conversion. And you're making the interest in this case, 3 cents. Now granted, look at our equalities here and look at what are your prices. We paid $2.75 and we sold it for $2.75. Well, what if we paid less and sold it for more? That adds to our bottom line down here of plus 03 cents. So by using the time spread, having the ability to go into a jelly roll, and then letting it unfold into a reversal, you see the opportunity where without any risk, we're locking up not a big money, but riskless money. The same would be true as if you reverse these spreads. If you sold the call spread and you bought the put spread, reverse all this around, it turns into a conversion. Now it's just a question of trying to get some premium for what you collect when you sell the spread so it overcomes your cost of carry. In this case, we were short stock, so we're collecting some money. Now when you look at a jelly roll and the way we did this example, you've got to remember that we are not using a dividend. If there was a dividend between or falling in any of these expiries in this cycle of these 28 days, you've got to either subtract that out or add that to. Being in a reversal, you'd have to subtract it out. So if there was a dividend of any consequence here, those prices we just did would lose. Okay? Now, if there was a dividend that you were collecting, all right, and let's say we did this for even, and the dividend was a dime, you'd make a dime minus your cost to carry. So in that perspective, you're making money because now the dividend works in your favor. Time spreads, jelly rolls, morphing them in to reversals and conversions. This is how a lot of the market makers, this is a lot of how the DPMs, this is how they built and basically organized the risk in their positions to basically reconstruct them into the equalities that I've been ingraining into everybody the last 3 webinars as to how you manage certain risk in your position.